from hosting to promoting to helping us get Wall Street Journal as the education series sponsor, so they've been instrumental in doing that. The other thing I wanted to do is I wanted to thank all the staff. So Christy, Melissa from 1871, is Maria here as well in the back. Thank you very much. And then I want to recognize the HBA staff, Alita and Michael in the back, if you guys could raise your hand. They are putting together and developing the content for this entire program. So they've been instrumental, and I want to make sure to thank them. One of the things that I wanted to kick off, if I could have any of the HPA members that are here tonight, if you guys could raise your hand, I would appreciate that, just to recognize. Awesome, thank you. So what I've realized is, y'all know who 1871 is, but before we start talking about the education series, I thought it might be helpful to tell you who HPA is. And HPA is a group of individuals that have been successful as entrepreneurs, successful as executives, or they're high net worth individuals that want to make a difference in Chicago. They want to make a difference in the Midwest. And the way that they've kind of organized, or we've organized, is we believe investing our time, sharing our experience, and investing our capital in entrepreneurs in the Midwest will make a big difference. We believe that successful entrepreneurs create successful companies, which create a powerful, robust ecosystem in the Chicago community and beyond. And we've had some experience. I think what we had, to give you a sense, is we have over 30 portfolio companies. We've generated through our portfolio companies over 500 jobs, and collectively with our venture capital partners have invested over $150 million over the last few years. So what we realize, though, as much as we want to help every entrepreneur we can, but together the members decided that we could do something really effective. We have some expertise in early stage investing, and if we could put together a program that could give entrepreneurs the information they need, it may help them become successful. So we might not be able to invest in everyone, because we only do a handful in the year, but we know that we could do this in a way that we can provide a program. So the folks that I had acknowledged before is that this is a 4-part program that we've done in conjunction with 1871, but the program doesn't stop here. It continues in the additional series, and it's also online. So we're providing content through our website, through our blog. We're streaming this live. We'll provide highlights, etc., so you can share with people that are with you and that you know that need this information. And I wanted to tell you a little bit about something. As we try to help the ecosystem, there are some partners in the room that help us help you, and that's our industry partners. Our industry partners, we develop programming around corporate venturing as well as corporate innovation. So we have some folks from Molex. If the folks from Molex could raise their hand. Awesome, fantastic. UL, Joel is here. We have folks from CME and Valspar, and what they're doing is not only working with us around corporate innovation, but they're investing in our portfolio companies and helping the entrepreneurs be successful. And then I wanted to also acknowledge our corporate sponsors. So all of you have a booklet in your hand, and that's meant to be able to jot a few notes down, but if you turn to the last page, you'll see our corporate sponsors. And those are folks, anybody that's a corporate sponsor has helped one of our portfolios, one of our members, or someone in the ecosystem. And we have a few of them. William is here from Silicon Valley Bank, if you could raise your hand. Andrea from Rainbow Hampshire Partners from Executive Recruiting. I think Bailey was going to be here from Wintrust Ventures. But I encourage you to look at those that are trying to build a community as you're looking at your needs as you build your businesses. So with that, the bottom line is we want to be able to share with you how to navigate this early stage environment. And today's session is around, are you ready to raise? And so I thought what would help the panelists a little bit is determine what's the makeup of the crowd. You guys are all good looking, that's for sure, friendly. Besides being good looking, I want to determine how many people here are either an entrepreneur or an aspiring entrepreneur. If I get a show of hands, that'd be great. All right, rock it out, go Chicago. Okay, second, so I kind of just, by the way, I had rotator cuff surgery, and this is about as far as my left hand can move right now, but I'm out of the sling, so I feel like John McCain a little bit. So we got a good group. How many people have questions about bootstrapping? Should I do it, shouldn't I do it, or am I ready to raise? There's the same amount of group. Put your hands up so we get a general sense. All right. So tonight we have a fantastic panel. I'm going to have them introduce themselves, but I think what's really interesting to know is everybody that's on stage or as part of the panel has started one or more businesses. So everybody's an entrepreneur, although we all play somewhat different roles as well. So while I'm getting choked up, handing it over to you, Troy. I hope this is powerful. Troy, why don't you go ahead and introduce yourself, and I'll let the rest of the panel introduce themselves, and then we'll start the session.
Thanks, Pete. So I'm Troy Honeycoff, Managing Director at Techstars here in Chicago. But first and foremost, I'm an entrepreneur. So started my first company right out of college. Depending on how you count, it's been between 6 and 10 of them. Depends on how old they have to be before you kill them for them to count as a real company. So I had some successes and some failures. You may have heard of some Jellyvision that I was early involved in, Sure Payroll, which I started, OneWed, Amici, etc. And have spent the last 5 years really trying to help this community with starting Accelerate Labs, which became Techstars, doing angel investing, and now doing venture investing through Math Venture Partners. So I've been on all sides of that table and love to help entrepreneurs.
Hello everybody, I'm Sean Carpenter. I'm a second-time entrepreneur. My first time out, 25 back in the dot-com boom, so I've lived through the kind of boom and bust cycles that everyone goes through. Spent about 3 years at Google, and now I run a company called Y-Charts, and we're about 5 years in, and the company's scaling nicely, so excited to be here.
Hi, my name is Genevieve Pierce. Can you hear me? It's on. Oh, it's not. Awesome. Hey, awesome. Okay. Hi, I'm Genevieve Pierce. I am two things. I am an opera singer and an entrepreneur, which is completely random. That you just reared back. You're like, whoa! Amazing combination, let me tell you. So I started SitterCity.com out of college. It did great. It's international now with over 10 million users in Canada, UK. Wonderful company, wonderful experience. But I actually stepped back a couple years ago. I'm on the board of the CEC and was helpful, along with all the other board and kind of supporting 1871 with Troy. I've been off kind of larking about for the last 2 years, just fulfilling my other dream to perform. So I had a Carnegie Hall debut, and I have a Lincoln Center debut in 2 weeks. I know, a little random, right? Probably didn't. Thank you. But I am sure, actually completely sure now, that I will be back very soon with another new play. I tend to focus on women in tech, but love everybody. Just happen to, focus on helping women, ideally, because, there's not as many of us as there could be. So I am also an investor in a couple of local companies personally, as well as with Firestarter and you guys. So that's me.
Everybody, I'm Chris Kubicki. I'm a serial entrepreneur. I've done a couple companies, all angel backed. I've also done a few exits. I'm currently the CTO of a company called Market Track here in Chicago. And I became the CTO when I sold my most recent exit to them in 2013. I also am the co-chair of the Digital Media Technology Group at Hyde Agency.
Hello guys. So my name is Matt Ivanchiko, and I'm the founder of 4Kites. We are a recently funded startup by HPA. I'm a first-time entrepreneur, and we are building a connected devices platform for logistics.
Changing the world, right?
Changing the world, yep.
Awesome.
One truck at a time.
So the first question that I'm going to start out, I'm going to frame it out. One of the things that entrepreneurs struggle with is that sometimes they think building a business is the second step to being an entrepreneur, and the first step is raising capital. And so they start along this path to figure out how can they raise capital without starting their business first. And so I'm going to turn to the panel, and I'm going to ask you to give at least one up to 3, no more than that, of why you would encourage somebody to bootstrap their company and for how long. So I'm going to start this question off with Christopher. Christopher, what's your response to that question?
So I personally have been very fundraising averse, and the reason for that is because I'm, in my mind, building these successful companies, and they're already worth what I want them to be worth, in my mind at least, right? To give away any of that seems like such a crime sometimes. So, in my mind, bootstrapping is the only way to go, and you only really raise when you absolutely need to. And so the last company I sold, I only sold actually due to competitive pressure, and even before that, the only money I took was really to achieve very specific goals that, I could live with the cost-benefit equation of, giving up that much equity.
So that's a good point. I think that one of the things as a entrepreneur, if you could break it down into what happens when you get an investment, you are going to give up some percentage of control or equity. And there's a lot more, but you can put it in very simple terms. And so, depending on your investment partner and the strength of your business will determine how much of that you give up. So Sean, White Charts is super successful. Everything's going to be awesome tonight. But clearly you've had a lot of success. And if you could rewind this bootstrapping question, what would you do differently when you started raising money that might have helped answer the question, what do you do, or what would you advise a group for how long they should bootstrap for?
Yeah, I think you do it as long as you can, and then as you see opportunities where you really need the resources, that's when you need to go and get the capital to bring the team on. So with my company, I had my co-founder and I, for a good year and a half before we took capital, we basically built the product out. We actually went to HBA in late 2009. And we were at a point where we knew the product that we were building was starting to work, and we needed investment to build the team out. We really put off as long as we possibly could in terms of taking capital on. And I really would be cautious to take capital before you know you have something. It would be really dangerous to raise capital because you can in this environment, and then not really have something that's meaningful, and it's bad for investors, it's bad for yourself.
Excellent point. And I think for all the panelists, I've got cues from the crew. The mic needs to be close to your lips. Awesome. It's about as close as I'm going to get to singing, and I am a horrible singer. Genevieve, so we're going to do this thing, yeah, we'll come to you. So Genevieve, I've heard your story on multiple occasions, but everybody's kind of talking a little bit about, in a good way, by the way. I've heard your story in a good, positive way. But when you looked, there was a certain element that you felt you needed capital, and it was hard to get capital because people didn't see the value of the business. And I guess if you were to share with the audience, when is it right to start looking for capital? And I might be off on that story a little bit. I got hit in the head when I was a kid, so.
It's your excuse for everything.
Yeah.
No, here's my thing, actually. I couldn't raise money for Sitter City, despite wanting to, back when I launched it. It was the middle of the dot-com crash, and, also, frankly, this is a thing that happens to hit, women or anyone that's not, in the mainstream. It was something that wasn't really understood. I think, and this isn't really anyone's fault, but I think your average, 50, 60-year-old guy, which is what I was generally facing with VCs, would probably invest in something he knew, which is like a beer company or a suit company, but he's probably, I heard it's a babysitting club, I heard my wife handles that. I mean, this was not an easy play to fund in any way. So just to go back to the timing of it, it was not ideal. I actually built Sitter City off of angel alone, I think. 3 rounds of angel actually we were $3.1 million a year in revenue when we raised a Series A, which was really difficult because they were trying to fit us in their boxes for a Series A, and we were way beyond that. So actually, if I were being honest, I would not do that again. So I'm examining a new play now, and I'm already talking to VCs because what I'm going to go in and I'm going to angel fund this, but I'd like to gather more angel funding for it. And frankly, I'd like to raise my first round very fast. Part of this, though, also depends on who you are. So there are two ways that I've seen to build a company. You can either copy and iterate. So you can find something that's out there and you can say, I'm going to copy this and iterate and do it better. It's a very scientific approach. Or you can disrupt and teach. Disrupt is when you create a new mashup. For example, Sitter City is a nanny agency mashed up with Match.com, mashed up with Monster.com. And I'm looking at something new now. I like to mash up three entities and disrupt and create something new. When you disrupt and teach, which is the way I like to go, you need funding and you need it pretty fast, because what can happen there is that you can open up, when you disrupt and teach, it's exhausting. You have to change people's way of doing something. So you can open up a chance for someone else to come along, gather a bunch of money, copy you really fast, copy and iterate, but they can step on your back as they do it because you've been out there slugging it out for years. So in my case, having seen that people that disrupt and teach leave themselves open to that, I would probably tend to raise more off the bat. But that is because I know what I am now. I am a disruptor, an educator, not a copy and iterate. So if that's helpful, I would go out for more funding off the bat.
And I think that one of the things that you have the benefit of is that you have some experience behind you, you have the relationships, and you also have a pretty good understanding of the marketplace and how to operate. And I think that that's what many entrepreneurs have, that experience. So I'm gonna swing it over to Troy, I'm gonna ask him to put his entrepreneurial hat, and he's been a successful entrepreneur. And so from your entrepreneurial perspective, what's your view on bootstrapping? You've heard the rest of the panelists talk about it. Maybe you can summarize some of their thoughts and highlight what do you think is critical?
Yeah. So I think about it along two axes. And one axis is the type of business that you're starting. So it highly depends on the kind of business you're starting. If you're starting a services business, one where day one you can go out and get revenue, that's awesome. That's an easier business to bootstrap, and actually one that is bootstrapped 99.9% of the time. At the other end of the spectrum is something like what we started with Sure Payroll in 1999, where we had to go out and buy servers and buy firewalls and host at Exodus for $4,000 a month. There was no AWS. But we spent over $1 million because we had to, just to get our MVP up back then. And then our first customer paid us $19.95. They paid that $19.95 every week, and we had a lot of them. And today, Sure Payroll quickly became the largest internet payroll provider in the world. And I mean, it worked out great, but you had to raise venture capital to do that business. So I want to contrast, there's this axis of the type of business that you have, and some can be bootstrapped, and some really need capital, whether it's yours or someone else's, but need a lot of capital to get going because they can't be cash flow positive from the first month. The other axis is greed versus fear. And greed versus fear plays into almost every business decision that we make. And clearly, the further along that you can get on your own power, speaking to Chris, the more value you are creating, the less dilution you will take when you raise money, and the more of the company you will keep. That's the greed side. The fear side, and I'll speak now. I'll speak now about the Sitter Cities of the world. What happened, we were talking about there with Genevieve, is that if I don't go out and have a lot of capital and nail this thing, someone else is going to crush me, right? And so you have that greed versus fear, and there is no right answer. It depends on who you are, what your makeup is, and what your goals are. Chris said something, said I built a company that was as big as I wanted it to be. It was great. I was happy with that. That was the right answer for him. For someone else, they may say, wow, this is really great. I've proven the model. Let's go raise $20 million and blow it out and make it be $1 billion company. That might be the right risk and the right risk balance for that person. So I think of it as two axes. One is the type of business you have. Can you bootstrap it? And the other is this axis of greed versus fear.
Excellent. So speaking of greed versus fear, Matt, from your perspective, you've just raised a round of capital.
Yeah, that's right.
And I guess, how do you see the market? You're probably similar to a lot of the entrepreneurs in the audience that had to navigate the landscape, and you got, as I always say, you're disrupting all logistical transportation in a great way. So how did you see the experience right now? You're probably closest to the ground.
Right. So we bootstrapped for almost 2 years before we raised the first round. And, as Troy said, if you have the model name down, then you can, go and raise money. But if not, you're going to have some expensive failures, right? You're going to fail at the expense of your investors. And we wanted to avoid that. So that's why we didn't raise money for almost 2 years. And we bootstrapped all the way until we had a product built and we had some customers ready to pilot it. So that's what we did. And once that was done, then, I think that bootstrapping helped because it gave us instant credibility when we started talking to investors because, we started, we were betting our own money and time against us. And so that's my story.
Excellent. So I think that if I were to capture some of the points that I think that if I were in your shoes, I would walk away with, I think that the game is not about raising money. The game is about building a successful business. And understanding whether that business is investable is a critical element because not all businesses need investment capital. And that's really critical because a lot of people might have a $20 million business that could throw off $2 million a year, and that's fantastic, but that is not attractive to a venture capitalist. So understanding where your business is, what the market is, I thought the group was really able to articulate, to understand the dynamics of, it's really an independent evaluation of your business and where it sits in the market. But to wrap it up, make sure you're focusing on building your business, not raising capital. Capital is just there to help you build your business. So with that, I'll swing it over to Sean, and as you look at raising capital at different rounds, maybe I'll back it up a little bit. So when I say rounds and series, so how many people are familiar with convertible notes? How many people are familiar with the Series A? All right, so we got a pretty good group. So one of the things that I'll preface this is that the way that if you're ready to raise capital, you're going to determine how you're going to raise that capital. Convertible notes are one option. And I guess, Troy, can you politely just describe the effective use of a convertible note and why they're being used a lot, and maybe contrast that with a price round?
Sure. So starting with the simpler price round is when you sell equity in your business, shares of stock typically, for a fixed price. I'm going to sell you 100 shares of stock for $10 a piece. We know what that transaction is. We know how many shares of stock are in the business. We know what percentage of the company he owns. That's pretty clear and simple. There's some rights that come along with it, etc., but that's how that works. In convertible debt, there are times when, I need some money. Will you lend me some money? I don't really know how much my business is worth yet, so here's what we'll do. I could pay you back, but really we'll convert it into stock when we get a fair price on the business. And so he may lend me that $1,000. We don't know how many shares of stock he's going to get ultimately. We don't know at what price. But at some point in the future, I may come over here to Sean. Sean makes an equity investment with price stock. Says, hey, I'll buy your shares of stock for $15 a share. And at that point, I'll take the money that I was lent and say I can pay you back in cash. But what if I just pay back in shares of stock? We have a fair market value price for the stock, so it's all the same. And really, that's what he wanted, because it was a risky investment. He didn't want to make 10% on his money, 5% on his money. He wanted to invest in the company and have that upside of 100x. If I'm Uber, it's a 10,000x, right? So convertible debt. There are a couple other nuances on convertible debt. Maybe he'll lend me that money and say, you know what? I'll do that, but when you cut your next deal, wherever it is, I expect to get a discount because I took more risk than they did. So I want a 20% discount on whatever price you sell the shares at in the future. That's fairly good. The other thing is sometimes there's a cap on it. I'll do that, but I'm not willing to pay any more than a total enterprise value for your company of 3 million, 4 million, 5 million, whatever it is. So that's kind of the mechanics. Here's where I think it works really well. If I'm negotiating this deal with Sean for an equity deal, but I'm running out of capital, if I run out of cash, he has the upper hand. Because as soon as he sees how low my bank account is and he's negotiating with me, I have no alternatives. I need to have an alternative to be a good negotiator. So I come over here and I say, hey, can we do some convertible debt? I'll be able to pay you back in like 2 or 3 months, or it'll convert in 2 or 3 months. It's a bridge loan, basically. So I have some runway so I can do a good job negotiating a good price. That, I think, is an awesome use of convertible debt, and that's where it started. What happens now is it's much easier to close a convertible debt deal. The paperwork is simpler. You don't have to make hard decisions. How much is your company worth? You don't have to fight about that. You don't have to decide on the board and board company. You don't have to decide on all kinds of things. And so what's happened is a lot of entrepreneurs have turned to convertible debt. Hey, why raise $1 million in equity if I can get it in debt? I don't have to make those difficult decisions now. I'll kick the can down the road and deal with it later. It might be a year later. It might be 2 years later. To the entrepreneur, it sounds really attractive. I don't have to fight over valuation. I don't have to fight over those terms. As both an entrepreneur and an investor, I believe that you should make the hard decisions sooner. I think that the logic of, I want to kick that down the road because I want to deal with it later, is a really bad reason to choose convertible debt. I believe that in a transaction, you should know what you're selling, and in a transaction, you should know what you're buying, and with convertible debt, you don't know. What percentage of the company does he own? We have no idea, right? And then there becomes some, and it's getting nuanced, but there becomes some misaligned incentives. If he invests in my company in equity, and now we're partners and we go raise that second round with Sean, we all want the best price we can from Sean. I get a higher price for the company, a higher pre-money valuation. Our stock is worth more. We are aligned. I like situations where partners are aligned. However, if he gave me debt, and he said, all right, we'll convert that when you raise money next, he actually does better if I sell at a lower price because he gets more shares of stock for the money that he already gave me. We're not aligned. And then this other weird thing happens that if there was a cap, let's say it was a $3 million pre-money cap, at the point at which I can raise money over $3 million, now we're aligned again because he'd love to get, because he's only going to pay $3 million, he'd love to pay $3 million for a company that's really worth 10 or 12 or 15. He feels like he got a great deal. So these funny disconnects happen and these funny misalignments happen. I know I'm a little bit in the minority here, but I feel strongly that convertible debt is a great vehicle for bridging short-term, 3 months, 6 months, there's an imminent close, but I don't like it when it's used as a replacement for equity.
So that fed into the point that I was going to make, is that I think we had a lot of people raise their hand, but it's a lot more complicated than I think a lot of people realize. And as you look at the type of steps you do to raise money, which we will speak to in more depth in the next session, Investing 101, we'll get into these specifics. But you have to be at certain milestones for people to invest in you in all of these different series. So a pre-series, so a friends and family, to a pre-series A, to an institutional series A, to a series B, C, D, and so forth. And so for the panel, because everybody has the experience, I think it would be helpful to get your perspective of what milestones you think are important for you as an operator to operate your business, and what you view is important for investors to invest in your business. So Sean, I'll start with you. What do you think are the key milestones that you need to look at?
Yeah, and it depends on what coast you're on. I've noticed like we've raised about $9 million in capital, and on the West Coast that's like your C or A round. But in the Midwest, I think the seed round, you really need to have a product that is getting traction. You feel like you're onto something. You have a team in place, a very small team, and you can get working on this problem. That's probably enough. And maybe you have some domain expertise within the company. You can probably get a seed round done with that, and then start building the company. clearly when you get to your A, B, and C round, you really have to get traction, just growing within the company. Deep traction, and as you get into your C and D, you're really onto something, you're scaling revenue nicely, you have both your engineering and your sales teams growing. So those are some of the things that I've seen across the different stages of the process.
So I think traction, I think everybody would agree that you need traction, but I can tell you for sure if I ask you what traction is and how do you measure it, you're probably going to get a lot of different answers in this room. So Genevieve, from your perspective, what do you think are key metrics that fall under traction? So I'll be ready to go.
Sure. Yeah, no, I have, so I bear in mind, I tend to build consumer companies. I tend to build B2C, and I also tend to build disruptive. But yeah, I see very clear, in my world, I see very clear signs between, the angel to the Series A to the Series B. In my world, an angel round, your seed round or angel round, proof of concept phase is usually about a year and a half. And for me, you can take anywhere from 500K to about 1.5. The goal of that round in my world is to create a mini money machine that establishes your initial metrics, not at scale, but your initial metrics in one market at sort of mini scale, right? In Chicago, for example. Some people pick two markets, Chicago and Boston. Now, I tend to do subscription. There's about 10 different monetization models for web mobile, I can go into those later, whether it be e-commerce or group buying or micropayments. I tend to do subscription as one of my primary models. So where I'm going with that is that the key metrics for me are cost per acquisition of a user, it's ARPU, average revenue per user, overall churn is a big deal for us. So I tend to try to go in and establish initial metrics right away with that year and a half, with that 500 to 1.5. But just to quickly say about the Series A, here's what I would say to frame this up for you. A Series A and a Series B should be viewed differently. You usually have 2 to 3 years, within that Series A period, Series B period, just generally when you're doing a consumer play. And the goal of your Series A, the way I see it, is to blow your concept out over a wider area and to go out and get those customers that need you right now. Okay, so direct marketing is the goal of your Series A. Google paid search, combined with, any kind of tactics you can do to get the person that needs you right now. When you take that Series B, Series A is 5 to 15 million usually. That Series B can be anywhere from 10 to 50 million, right? That Series B is to get in front of everyone that you want to serve, whether they need you or not. And I like to frame this up for people because I think it's very important that you understand that there's a Series B that might expand you. Perhaps on your Series A, you take it from Chicago to nationwide. On your Series B, you might take it international. But the really critical thing to do in your Series B is to break out your brand marketing. Series A is about direct marketing. Series B is about brand marketing. And you're going to get in front of her, in my case, or him, whoever you're serving, whether they need you or not. Does that help?
I think it does, and I think you frame it from when you're looking. I think one of the things you can tell if you have a good traction metric is if you stack it up month over month, quarter over quarter, year over year, and it's telling you a trend of the health of your business. I think that is something to kind of chew on, to think about, but you should be able to show growth, that you are measuring the right things, not the things that you might put in a presentation that shows growth, but really matters to show the adoption of your business. And so I'll swing it to Matt. You probably wake up at night sometimes thinking about some things that are really important to you. What would you say is the #1 metric that you think is critical to your business?
So I would say it is the market traction. So we raised our seed round. We were pre-revenue at that time, and there were 3 things that we were looking for when we went out to raise the funds. So one was, as a B2B startup, we are solving a very specific pain point, and it's a pain point, it's a market validation for that pain point, right? So that is the very first thing that we were looking at. And again, can the customers vouch for us to the investors? That was the second thing. And the third thing is how much money do we need to build a scalable business model. So those are the kind of things that are still, keeping me up at night, because, we are such an early stage and we are a B2B company, and we are, looking at how to scale it up from just, a couple of customers to, hundreds of trucking companies all over the country.
Okay, thanks. And I think that as you were giving me that answer, which is powerful, thank you. Troy was, I thought he hit a really good point, and I'm going to frame it to you, Christopher. So there is a term in the industry as vanity metrics. A good example of vanity metrics is aggregate or cumulative new user activation. So it doesn't account for churn and people that don't use the product. And if your business isn't going up and to the right in that vanity metric, you got big problems. That's when you close up the computer and start something else. But on the flip side, though, with regards to looking at metrics that are measuring engagement, Christopher, in your business, what are some of the things that were critical to you to say, okay, people are really using my product, or there's clear adoption that they'll use it time and time again, and they're going to tell their friends to use it because they like it so much? What are some of the engagement metrics you look for?
Yeah, so I've been on both the B2C side and B2B side. My last business was on the B2B side. And we watched the users very carefully. And for us, it wasn't about sign-ups or user acquisition or anything like that. What we were specifically looking for was power users. And so specific users on the account who were extremely engaged in the business. And we would take the users aside. Sometimes we'd fly out and see them and stuff like that. And literally just watch them and see what they were doing. Some of these guys were taking the software and turning it around and making their companies millions of dollars a month. So we tried to bottle that up and see how we could kind of quantify that. And really we kind of came to this enthusiast metric. So I would hope that that's not a vanity metric, because that's never going to get you funded. But as far as building a product, if you can find and identify your core users, I mean, think of like the original guys on Craigslist or the original guys on Reddit, right? Like those people ended up building the product for the product managers and the engineers. They were really the key drivers into building a successful business. So once we could tap into that, we knew that we had success. And all the other things that make successful businesses, monthly recurring revenue, subscriptions, user base, all kind of flowed from that.
Thanks. And I think, Troy, I will swing it over to you and let you perhaps add a few additional comments, because I think this point's really important, and I know that you communicate this to the Techstar companies as people are looking at it, so I'd love to have you share your thoughts with the group.
Right. So those vanity metrics that can only go up and to the right because they're cumulative numbers are useless when monitoring the health of your business. What I like to see are numbers like, so maybe if it's new accounts that you care about, different businesses are different. If it's, in your case, maybe it's new power users you care about. I want to see a bar graph of how many new power users did I get each month. And I want to see that the number of new power users is going up. The number of new power users added is going up each month. This month I got 5, the next month I got 7, the next month I got 10. It's not cumulative, right? That's how many new ones. So the rate of increase is increasing. And that's when you know that you have something great, right? So all of those metrics should be by period, by month or by day or by week, whatever's right for you. And it's always, you want to see the rate of increase increasing. If that makes any sense. It's easier with a whiteboard.
We'll get one next time. And I think it's really important, because what you're looking for as an investor is you're seeing a pattern of adoption, and you want to be able to project that adoption into markets which the company hasn't been able to reach yet. And so the evidence and their traction is really showing the value of their product or services that they're providing. And so the more traction that you can believe that more people are going to use based on the amount of time they've been in market, that data, those metrics are the evidence you need. So that becomes really critical, and I think that there are plenty of places to find information about this. We recently wrote a blog on traction, at Hyde Park Angels, and so you can take a look at that blog. I think it'll really speak well to drill into this point. And we reference several articles that really dig into that. So, okay, my business is doing awesome. I got all the metrics. I bootstrapped it, and I'm gonna go raise. It's ready to go, perfect day, rainbows outside, la. So, what do I need to do to go out and raise? What is the first thing that you think an investor would want to see? And Sean, from your perspective, do you go out to all the investors? Do you go out to select investors? Why don't we target the investors first? Give me your thoughts on that, and then what do you need to prepare for them to determine if your business is the business they want to invest in?
Yeah, I mean, I think you definitely do the research to find investors that can add a lot of value to your company. You clearly don't want to get money into the company. You really are looking for a partner that's going to be with you for the next 7 to 10 years. So finding people that have been successful doing your type of business is probably the number one thing that we look for. And you might look at 10 to 12 potential investors that kind of fit that profile. And then talk to entrepreneurs that have taken money from them and find out how much value do they add. Because once you take the capital, you have this guy sitting on your board, and if you don't like it, it kind of sucks. So it's helpful to really understand who you're going to try this relationship with.
What if you don't like the beard he grew once he joined your board? Is that
I actually make my co-founder shave his beard every board meeting, but although as we've gotten further along, I guess he doesn't always do that.
All right. Beards are good.
Beards are great. I grow one every time I go to a meeting. I want you to know that. Power.
Awesome. I could quickly regress off of this topic, and I need to focus and get it back on track because so many things are entering my mind. So you're ready to raise. You got to find the right partners. It's more than just the capital, especially if you're in a position where you got the right metrics, you're creating value. Is there too few to go after? Like if you feel so confident, you only go for 3, or is there too many? And none of you, I see you shaking your head, so I'll swing over to.
Yeah, well, I would probably keep it in the family, I'll just say, because, well, for me, it's more about trust. To your point, you're going to be in the room with these guys a lot. I also have an unusual thing where I tend to build for industries that are less well understood. So, I'd probably go with people that have identified themselves as investors that are okay with that. They understand I'm going to bring some extra information on the industry because maybe they haven't lived it. But I would say if you've established trust, which for me is the most critical thing, I wouldn't let that go. So, when I first went out, oh my gosh, we established a huge funnel. A funnel is a sales analogy, and it's one that I'd really like to impart to you guys. Think of a megaphone. Here's the big end, here's the tiny end. You need to pack VCs in there, and hopefully 1 or 2 will fall out with a term sheet. But you need to talk to at least 40 to get a term sheet, in my mind, when you're first coming out of the gate. You've not done this before, and it's really hard. You got to go to the East Coast, you got to go to the West Coast, you got to hit up Boston, New York, you got to go to Silicon Valley, you got to hit up, all of those different areas to get these 40, pack them in the funnel, and then you got to go down the funnel, right? Email number 1, email number 2, meeting 2, meeting 3. Have we shared all these documents? In my mind, the templates that you use are very simple. You bring in a cap table, you bring in a 1-page exec summary, you bring in a PowerPoint, you bring in a 3-year financial projection, and if you need to, and I like to do this for the exercise, you bring in a competitive summary, right? So, I've done all that. This is a brutal process. Why would you do it again? So, I would hope that the investors I've already proven myself to would work with me again, and I would definitely bring it back to the family if I could on round 2. But we'll see. Maybe they won't. maybe they're like, nope, and then you have to move on. Who knows?
All right. Well, I think that the scope that you're targeting, I think the one thing is you are unlikely to be able to use just a small number. And I think that the scope of how many is too many could be debated, but I think that going to too few is probably even foolish because you don't even create a competitive situation. But I'll swing it over to Christopher. Christopher, I believe you said that all of your companies were only funded through angel investments. And I guess, how do you differentiate between an angel investment, an angel group investment, and a VC or institution, and why did you choose angels?
Yeah, so I'll preface by saying, so I did the funnel or the circuit, as I like to say as well. You know, before I exited my last company, we got to a position where it was raise a huge round or just sell the thing. I really can't emphasize enough that you do have to talk to a lot of people, and that's like super not fun. But back to the angel question. So what is like, I think, good angel investing look like, and you know, what is kind of the structure for that? So all of my previous businesses have been kind of the more structured angel capital, so very similar to what Hyde Park Angel does. You know, like angel rounds in particular are very intimate relationships. You know, so the people that you're interfacing with in an angel round usually will sit on your board. They're usually very active. It's typically not a lot of people, and it's a network that, you know, is probably not very far off. So these aren't folks on the West Coast. These are folks, you know, within a few hundred miles of you usually. And I think that that's, you know, one of the elements for a very successful angel partnership. So somebody who has a lot of interest in the business, somebody who can contribute monetarily to it, but really is investing their time more than anything to get a return on their investment.
Thanks, and I think that, you know, from your perspective, Troy, you probably could connect with that. I mean, you've been an angel, you've been an individual angel, you're now running a VC fund. From your perspective, maybe you could provide some insights about what should, when a potential company comes to you, and I guess you can choose where you want to play in this round, but or maybe answer it from a couple of different perspectives, an angel and from a VC. What do they need to be able to convince you to be able to have a meeting with you to really show the value? If you can give some insights, what they need to be prepared with to pique your interest is what I'm hoping you can share with the group.
Sure. So first of all, I want to define the term. So angel versus VC, because I used to be unclear about that. I thought it was the size of the check. You know, maybe anything under 100K I considered an angel, over 100K considered VC. I have a very clear definition. If you're investing your own money, you are an angel. There's some angels who will write $1 million checks. They are still angels. If you're investing other people's money, you have raised a fund, you have a fiduciary duty to them, you are a venture capitalist. VCs, there's some VCs who will write a $25,000 check. It's not the size of the check. So, and the behavior is very different. When I was an angel investor and I was investing my own money, I could, you know, I really like that shirt. I'm going to invest in you because I like that shirt. I can do that. It's my money, right? I have no responsibility to anybody but myself. I can do that. And so it's built on relationships, and it's built, and you have an individual who's making a decision for him or herself. When you're pitching venture capitalists, they have a fiduciary duty to the people whose money they are investing. A VC fund is like a mutual fund, except instead of investing in public securities, it's investing in early stage companies. I really liked what Genevieve said about trust, but there's a way around that, or there's a way to gain trust over time. It takes time, and I think if you wait until the moment that you need money, and you go out and you pack 40 VCs into the top of your sales funnel, you might be lucky to get one term sheet, because you haven't given them time to build that trust. The way I much prefer to do it, and this is part of what we do at Techstars, is I want to get you, as the entrepreneur, in front of potential investors early, before you need money. I want you to meet with them, and I want you to talk to them and say, hey, I've got a great idea, a new business I'm looking at. I'm not looking to raise money, but I'd love your advice. Can I get some advice? Here's what I'm doing. How would you do it differently? What metrics would you want to see, you know, in a company like this for your fund to invest in say 3 or 6 months? And if I do that and I build a relationship with Sean, and I apologize, I keep picking on Sean, but he's next to me, and I do that over time, and I come back 3 months later, and I've nailed some of those things that he asked me to do. And then I ask his advice again, and by the third time, he's asking me if he can invest because he's seen that trajectory, that progress. And so I think it's much easier if you start earlier, you start building relationships. Never ask for money first, ask for advice. Because you know that when you ask for money, you usually get advice. When you ask for advice, at least you have a chance you might get some money. But so ask for advice and build that relationship and show that trajectory over time. And if you know that you're doing that, here's the dirty little secret, which is as entrepreneurs, you like to puff out your chest and say how great your company is and rah-rah. But if you do that, the first time you meet with them, you set a pretty high bar. And they're looking for the trajectory. So now you've got to, so if you're a little more modest that first time, and maybe even sandbag a little bit that first time, right? The next time they meet you, you know you can show progress. And then the next time you show progress, and if the investors invest in a line, not a point.
I just did that today. Sorry, I didn't mean to cut you off, but I literally all week I've been doing that with something that's just a gleam in my eye. I'm just examining it. But I've done 5 calls this week, with different new investors from some of the same funds that have worked with me, and it's just so smart. Yeah, it's a great point.
Yeah, when I talk to people about raising money in general, I tell them think about creating a trains leaving the station kind of feeling with the VC. So I meet Troy and I tell him I'm going to do this. Next time we meet, a month later, I did it and I beat it, and then another month later, it flips. Where he's like, hey, you know what? I know some other people. I'd like to invest maybe some other people. And I've seen it over and over and over, but you definitely can't go out and put this, I'm going to crush the world, and then you meet next time and you didn't do it. You're pretty much done there. So.
And I think, Christopher, go ahead. Wow, the whole group is lined up, ready to go. Like we are like dueling mics.
Troy, I think kind of nailed the whole paradigm. Whenever there's a transaction, somebody's selling somebody else, and I think successfully with VC, when people are selling you instead of you selling them, you're starting to do it right. So.
Yeah, I cannot stress enough about the need to build a trusted group of advisors. That's what I did for 2 years, and they made the introduction to the VCs. So they knew the personally, so it worked out very well. So we ended up talking to just few VCs and we got a term sheet. So but it was as a result of the relationship that we built over 2 years.
And I think you guys are hearing the word relationship and trust. And when I was sitting in the audience and roles were reversed, I'd often feel that term relationship and trust was just a crock. Like, yeah, you know what? They just want my business and they want me to do really well and all of that. But every dynamic in this early stage investment sphere is about relationships, and good relationships are based on trust. And I thought Troy hit something that I cannot emphasize enough. Many people create their own problems by over-promising and under-delivering. And you got to remember, you are creating the market. No one knows what you can achieve when. So think about what you're telling the potential investor and scale it back. And then come back and tell me you've exceeded it. That allows you to build trust. And it is a trust relationship. I mean, everybody, 100%, right? So I think that was excellent points by the entire panel. Thank you very much. I think that, so building trust and showing the evidence points. Now, I got a meeting. They trust me. They've seen I got a little traction. I show up. What do I have to show up with? Is it...
I didn't answer the question, did I?
Yes, you did. So you're in the meeting and you're ready to go. Unless you want to answer it, I'll swing it back. Do you want to answer it? All right, let's do it.
So many of you have seen pitches, whether it's you've watched Shark Tank and you've seen those guys pitch, and I can't tell you how many people come into my office and will pitch, and then I'll ask them about the deal, and they'll say, "Oh, I'm selling 20% of the company for $500,000." And I look at them and I say, "You've been watching Shark Tank, haven't you?" And then I tell them that Shark Tank is to what I do like the World Wrestling Federation is to the Olympic sport. It's made for TV. There are elements that might be real, but it's about entertainment. So the terms that you use, the language, if you are raising money, if you haven't already gone by Brad Feld's book, which escapes me for the moment, Venture Deals. Venture Deals, awesome book that explains how venture works, and so you know what language to use to talk about pre-money valuations and post-money valuations, and you understand the terms, that way you're not going in blind. So what do you go in with? So when you see, whether it's a demo day of Techstars or anybody else, or it's Shark Tank, you see these presentations where people are standing up and it's all about pomp and circumstance, fancy show. That is not what a good investor meeting looks like. As a matter of fact, if you have a deck and you start and you get from slide 1 to slide end uninterrupted and you feel awesome, you have just failed. The best investor presentation is really hard on you because you get to slide 2 and they say, hold on, tell me about customer acquisition costs. And you have to answer their question. You can't say, oh, that's coming, please hold. Because they won't listen to a word you say until their question is answered. So the best tactic is to jump to that slide and talk about customer acquisition. And say, whoa, whoa, hold on, but lifetime value, where is that? And then you jump to that. And where is, and you realize your hour is up and you didn't even get to slide 3. And you feel horrible. And it was an awesome meeting, right? Because you engaged them. You have to think of what the goal of the meeting is. What is the objective of the meeting? The objective of that first meeting is to engage them. You start by starting to tell them a story, and hopefully there are enough hooks that they take you to where they want to go. It's no value for you to hear your story again. You want to go to where they want to go. And typically investors have ADHD and they're all over the place, and you're fighting with their phone, right? Their email and Twitter and all that stuff. So you have to have an attractive story. So you need to have a deck that frames up the conversation, but it's really a conversation. It is not. Success is not going through the deck. Success is getting them hooked. But the deck is the background. I actually would, there's some other things that I do. You want to engage them for the next meeting because they're not going to invest right there. You're not going to get a check there. So the goal is get them engaged, get that next meeting. It's a sales process. And so there's some things that you don't have. For example, one that worked really well for me is you have some lightweight financials in your deck, probably 4 or 5 lines of revenues and costs for 3 or 4 years. And then they say, oh, what's the backup for that? So I've got a beautiful financial model that I'd love to share with you at some point. Well, can you send it to me? No, that model, it's really complicated. What I'd like to do is schedule 90 minutes with you and an analyst, and I'll sit down and review the model, and then I'll give you a copy. Oh, no, we're really good at Excel. Just email it to me. No, I don't want to waste your time. I want to be respectful and show you how. You see what I'm doing? I'm getting the next meeting. And that's what you need to do. By the way, backing up for how you get that first meeting, many times investors will say, send me the deck. My advice is do not ever send the deck. Can I be clear? Do not ever send the deck. They will tell you they want the deck. They will tell you they won't meet with you without the deck. Don't send the deck. Right? The deck you hold hostage for the meeting because you need to be face-to-face for them to actually invest.
I got one tweak on that, Troy. I like to make 4-page decks with 48 backup slides and send them the 4 slides.
You could do, maybe, I could do that. What I suggest is you have a 1-pager, an executive summary. And the executive summary is what you send. Oh, I'll send you my executive summary so you know what it's about. You have to send them something. And they say, well, send me the deck. And then you say, no, my deck needs to be presented. Did you ever see Steve Jobs present, his deck when he presented the iPhone? It had 1 word, imagine. You can't send someone that deck and expect them to get it. It's got to be presented. Yours should be the same way. And so you have these series of steps that are teasers. And the 1-pager that you send is like the trailer to the movie. So you guys go to the movie theaters and you see the 60-second trailers. The good ones show a suspenseful plot, and they show sexy co-stars, and they show really cool special effects, and, oh, I gotta go see it, I gotta see how it ends. When you see a trailer that shows the suspenseful plot, the sexy co-stars, the cool special effects, and the ending, I don't have to go see the movie. Do that with your 1-pager. Show them the sexy co-stars, the suspenseful plot, and the cool special effects, but don't tell them how it ends. Leave them wanting for more so they'll take your meeting. That's how you're going to get the investment.
And that's the answer. All right. You absolutely can. I think that, sure.
Yeah, all I was going to say was that Troy's advice is brilliant, but the other thing I'll offer to you as well alongside his advice is absolutely do all that. If you do get to advanced stages with somebody who wants to throw down a term sheet, eventually you do share all of the stuff. You share the deck, you share the exec summary. So the 5 documents you need again are you need a deck, you need an exec summary, you need 3-year projections, 3-year financial projections, which they all know is BS. But, it's the more sophisticated your BS, the more likely they are to invest in you. It needs to be really good BS, right? I like to do a competitive analysis. This is all great for you. If you haven't done this, you don't have a company, right? And then finally, I have a document too. It's a cap table, but actually I shouldn't take credit for this. My husband, Dan, who's brilliant, put together a build document in Excel where you can literally say, all right, I own this amount, my co-founder owns this amount. Here's what happens if we do a pre-money, if we raise 5 on a pre-money of this and a post-money of this, and the option pool looks like this, and the share price is this, and it all spills out. And then it does the Series B. So all you have to do is plug in the numbers, and you can walk away going, oh, wow, in 7 years, I will make 10.3 million if everything goes right. That I like to do from the very beginning because you need to prep for at least a 5 to 7 year journey. Here's where I'll wrap up with this. I have these templates, and I will happily send them to you. Maybe I'll send them to you.
We'll put them on our blog.
Yeah, it's just good to work off of a template that's already been made. Now, they're not terrific at all, but they're there, and they're a start. And it gives you something, because I think a lot of people just don't have a start.
So, thank you. And I'm going to just do a quick summary, because I think the points that we're making, I think if you go back to the first point, is when are you ready to raise money? And I think that understanding where your business is, what market it plays in, etc. is critical. So once you realize that you are going to raise money, understanding what the data points or the milestones to show growth, and how that growth is a pattern become critical. Then you start building relationships with people that will invest in you. Those relationships are built on trust and providing information that provides evidence that you are growing. And as you begin to start the dance with the investor, you start to provide information to them through presentations and one sheets and so forth, that allows them to summarize your business so that they are speaking to their partners in the same language and they're speaking to you. And there are, I thought, some excellent points that were provided. I think that one thing that I think the audience would like to talk a little bit is about the projections. Because we always say, oh, the projections are BS, but they have to be projections that are going up for a long time, that are a lot. And so if you show that without any type of validation, then you get thrown out. So it's funny because I think that was mind-boggling. And to project 3 years out of nothing is really hard to do. So I'm going to swing it to Matt and just say, how many times have your projections changed and how hard were they to come up with the first time?
So I think it was changing almost every week when I was raising the round. And it's not, the amount itself, but it's, have you thought through all the different points, right? What percentage of the salary is the benefits? Is it something that makes sense? And have you thought through, what are the different expenses that will occur after you, hire people, right? So thinking through all those points and, putting them in the spreadsheet, and, it doesn't matter how much, what the amount is, but at least thinking through those points, I think that's what investors are looking at.
All right. So Sean, what are your thoughts on the projections you put together, and what advice do you have for the group as they do that?
I would say we definitely missed ours a couple times, but now we're further into the business and we're getting really good at actually beating the models that we put out. I think the key thing as you build a model is really think about the unit economics of whatever your business happens to be. If you can talk about individual kind of, in my business now we're building sales pods. We know how much revenue is generated every month, and it's a very scientific process at this point. But when you first get started, you have to understand what those key drivers are, and the more elementary kind of, simple types of ways you can look at your business, the better. When you see these models that are percentages of X or whatever, you know those are not very good. Or you can read some of the TechCrunch stuff when they talk about you just do T2, D3 once you get to 2 million in revenue. And that gets you to 144 million in revenue, and you've got $1 billion.
Easy peasy. So, I found a way to torture Troy is I'm not going to ask him another question, but I will because I don't want to torture you and you're up here as a favor. So, Troy, why don't you weigh in?
So, Sean said something really important. He called it a model, not a projection. And I think, and I do a 90-minute seminar, I do it at Techstars, I've done it other places on financial modeling. I think it is critical that you build a financial model of your business. And by that I mean, you have a set of assumptions. Those assumptions are drivers. They drive everything else in the model so that you don't type in any numbers of how many customers you have. You actually have assumptions of how much does a customer cost? How much can I spend per month? How much can I, and the assumptions are the only numbers that you type in, and they drive the output of the model. The output of the model is projections. You should do this for a couple of reasons. One is that by thinking critically about what the drivers are from the bottom up, this is not top down. If I see a model that says I'm going to get 5% of the market and it's top down, I throw it out. It's of no use to me. But if it's bottoms up, how much is each customer going to cost? How much is each pod going to generate in revenue? What does a pod cost me? How does that roll out? That's someone who really understands their business. And your opportunity when sharing that financial model with the investor, by the way, doing it face-to-face again, getting a meeting out of it, is to demonstrate you have clear and logical thinking and you have a command of your business. The first thing that I say when I present a model is, the only thing I know for sure is that this model is wrong. And that kind of takes them aback, but it now sets the stage. I'm not defending my model anymore. I'm there to talk about the logic behind it and to convince Pete, the investor, that I really have thought deeply about this and I understand it. And he'll say, I don't think it's going to cost you $10 to get a customer. It's going to cost you $15. I know my model because I built it. I know I can afford to do 15 and what the impact is. All right, let's change it to 15. The whole thing changes. We now have new outcomes, right? When we were raising money for Sure Payroll, literally I did that trick where I said, spend 90 minutes, your associate and you, and I'll share the model with you. Every single VC that we shared the model that spent 90 minutes with us either invested in the company or made an offer to invest in the company. 100%. Because they walk. First of all, there's selection bias. They wouldn't invest 90 minutes if they weren't interested. But they walked out of there saying, wow, he really understands that business. He is a clear communicator. He understands where the levers are. And you will learn things by building a model of your business that you never fathomed. Like what actually matters and what doesn't.
So I think that, well done. Earned, maybe, we'll see. But I think, so I'm going to drill into a couple of points. So we were talking about the metrics that matter, the engagement, and those engagement factors better work into the logic of your model. And I think that Troy spoke to it. It's the logic as the entrepreneur that you can explain your business. That's what's being tested. And that's why the financial is BS, because it's almost impossible to predict a market that's unknown with a new product, with people that haven't done it before, or maybe have done it but in a different product. So it's the logic, and I think that's a critical element. So what I'm going to do now is I'm going to wrap up with one final question, and then we're going to open it up with Q&A. But I wanted to make one point, which I think is real important, being the managing director of Hyde Park Angels, is you heard what a VC was and you heard what an angel was. You didn't hear what an angel group was, and that's what we are. And I think it's really important to understand is, like I said, we have 100+ members that have successfully navigated either their entrepreneurial career, their executive career, or some form where they've been successful that they want to invest back. And by working together, we can standardize the process and invest as a group. So you might be aligned with a member that has specific expertise, they can help you, but we will invest as a group within your group. So it's kind of like a VC in that way, but you kind of have the desire to help you as an entrepreneur, as a member. So that's what a group is. That being said, what I would like, and we'll actually start with Matt, if you picked your favorite entrepreneur out here, and you guys are having a beer or a coffee or whatever your beverage of choice will be, and you were to say the one thing that I have learned that you must know before you start to do this, being raising money or bootstrapping, you can choose, but if you have one lesson that you were to share with them, your favorite one, so it doesn't have to be everyone, but what would you say?
So I think it would be, don't try to do it alone. Try to build a team early on. I made that mistake. I was a solo founder and tried to raise money, for almost a year with no luck. But once I started bringing people in and, build a team, everything started working out. So build a team, hire people smarter than you, and that's, doesn't matter. So let them do the work and everything works out.
Perfect, easy peasy, disrupting the world. So, Christopher, what would your advice be? Your favorite person here, and maybe after a beer or two, so you can really lay it out.
Yeah, and I think, a lot of us are probably going to have pretty similar answers to this, but, that early team that you build together, so that early team of investors that you're sitting in your quarterly board meetings with, or, the guys that you're hacking the product together, or whatever. When you start off, you don't get a lot of opportunity to kind of start over. I mean, you can wipe the whole thing out and start over if you want, but that core group early on becomes the kind of nexus for your whole company, right? And you're the founder, right? So everything gets built up around you. And those are the people you're going to be with 5, 10, 15 years down the line. And, there may be thousands of people around you at some point, still supporting that core group. So I can't emphasize how important that initial seed really is. You have to absolutely advocate to get the best and the brightest to work with you on that first part.
Genevieve, I have some bad news.
I do too.
You can, you pick your favorite person here, and you're having coffee. I like that, you already picked it.
I like this glass.
But you cannot tell them that the secret is pick the right people.
No,
all right, perfect.
I have two things. That's my bad news. I have two things I must
All right,
tell
we'll give you two.
equally important. Okay, the first one is keep it simple, stupid. Do not try to make anything perfect. Just make it good enough and get it out the door. I see so many entrepreneurs just spinning. Second piece of advice, do you guys know the vitamins, aspirin, morphine analogy? Okay, well, I have to give credit, or credits to Martin Clifford, our new CEO at Center City. He's a brilliant guy. Taught me this. You need to go after the morphine. So when you're building something, you can build vitamins, aspirin, or morphine, and it is in response to a certain level of pain, low, medium, high. To be frank, when you're going after what you're going to build, you've got to center in and find that morphine, because when you're looking at aspirin or vitamins, you're just never going to get enough traction off the bat to really walk away with a lot later. So I tend to find morphine. If a mom loses her nanny, her life falls to pieces. People will do absolutely anything to lose weight and keep it off, those kinds of things, right? So this is my best piece of advice, I think. Find the morphine. It takes forever, a lot of focus grouping, a lot of drinks, many bottles of wine. Find the morphine and build to that morphine, and you will not lose.
I'm going to tell that to my wife when I go home, that I was advised to find the
Drinking
morphine.
part.
I'm startup, I'm going to go find as
And then
much
the drinking
morphine as I can, because it's painful.
Genevieve here says to drink.
All right, well, so I think that's great advice. I think it goes back into traction and finding that true engagement, and that engagement from that person that really needs your solution. So you're solving a big problem, and your problem, your solution, is that morphine. So that's excellent advice. And Sean, I'll give the same question to you, but you cannot advise, you can't recommend morphine or people. So
I'm going to have to overrule that question.
oh, all right, fair enough.
It's honestly all about the team. You have to get the best team you can possibly get, and I would say as soon as you start thinking about your business, start looking at your network and who you have you can possibly bring into this, because the idea is like a tiny fraction of how successful you're going to be. It's going to be all about the team you can bring in. And then the second thing, this is my second company. My first company, I hired a lot of people on my initial team that looked a lot like me, did a lot of the same things. first you make that founding team, I think the better.
Okay, thanks, Sean. Troy?
So we're entrepreneurs because we like to control our destiny. And it's easy to focus that energy controlling your destiny and trying to make the best perfect product you can. Genevieve was alluding to that. Don't get hung up in that. The most important thing is customers. You have to be maniacally focused on customers. That means going out and talking to them. That means selling them. That means figuring out what the channels are, figuring out how you're different than the competition. If you don't have customers, you don't have a business. Don't focus on anything but the customers until you start getting them in. And so we were just looking at an investment. We were looking at two investments. One investment where there was someone coming in who wanted to raise $3 million to build an elaborate system to then go out and get customers. The second was, and they were both seasoned business people. The second was a very seasoned entrepreneur who came in and said, I found this pain. I signed $650,000 worth of contracts, and now I want to raise $1.5 million to go build it and deliver. Which one do you think we're going to invest in? Right? Go get customers. Nothing matters more than customers.
Excellent. And I'll provide my insights as well. I think that understanding the pain in the market is critical, so what the customer issue is. Does your solution truly solve that? And you'll be able to determine that by the evidence that you can see from the data that they're using your product. And then I think you need to make sure that that solution that you have created by the evidence that the market's big enough to either be an investable business or a wonderful small business. And then you need to look at your management team, the team around you, and determine if they can take the market that you see from your initial traction. So that's what I would say. I would just kind of point everyone together. So I think from a summary standpoint, I hope to do that. I think that I want to thank the panel. We're going to open it up for questions. And so if we could, I probably need mics in the audience so that it's really important you say your question into the mic. And then if you could direct it to somebody in the panel so that they can answer, that'd be great. So, Alita, I'll let you.
Thanks for the comments, really helpful. Co-founder of Mentor, we're building a platform that eventually is going to be a platform, but starting with services. We love to bootstrap. We've been getting some advice from incubators, VC-type people that are saying that you don't want to confuse a business as a consulting business or a services business when it's actually going to be a software or a platform business. But we don't want to, we want to keep that sort of bootstrapping kind of idea front and center. Any tips, ideas, how you sort of do the first 50, 75 customers in a non-scalable way as a service, knowing that you're eventually going to turn it into a platform?
So I've done both. I've done that. I lived that. My first company was custom software as a service. We were bought by a company that had us build products for the healthcare market, and for a while we were trying to do both services and software, and it's really hard. They're different cultures. They require different skill sets. It's horrible. My advice would be to get customers to pay you for the product that you want to build, and the hard part is staying true to the product that you want to build. The slippery slope is, well, I'm paying you, I want you to do X, Y, and Z. I want it to slice, dice, and make julienne fries. And that's not in your product roadmap. And you have to make some really hard decisions. And I think what you have to do is be upfront with them. We are building a software product. We'd like you to be a beta tester. We'll give you a discount. But you have to pay XXX dollars up front to be the first one to use it and help us build it with you. And you'll have some influence on it, but it's our product. If you sell it to them as custom software, they're going to take you down a rat's hole, and it's going to be horrible.
Genevieve, since you come from the B2C space, bootstrapping, B2C, B2B, which is harder to achieve? If you're bootstrapping a B2C or B2B, which one is harder to get ramped up?
I'm gonna give you an interesting reply. First of all, B2B is very in right now. But the reason I like to focus on B2C is that I think there are still a lot of issues, particularly for women, that haven't been solved. So there's still a larger slice of B2C market left for us, just morphine pain points of ours that haven't been addressed. So I still like to build B2C now. Bootstrapping. Here's the deal. Usually when you're doing B2C, you're doing two-sided marketplaces, and that is exceptionally hard. I don't know, but to be frank, I bootstrap everything. I think if you haven't bootstrapped something and created initial metrics and built a minimum viable product, nobody should invest in you. I wouldn't invest in me unless I had all that stuff. But it's harder to bootstrap something that's B2C, I think, because you've got to build the two-sided marketplace. I can't tell you how hilarious it was me running around. I got 600 sitters with 20,000 flyers, and then I got 1,000 parents, paired to those 6,000 sitters, and the ratios had to be just right. Now, here's what I will say, bootstrapping an angel, from a demographic perspective, is actually a lot easier, ladies, for us to bootstrap and get farther. That's because women, particularly moms, are insanely viral. We tend to be, in the beginning of Sitter City, one mom was 12 moms. And I think that might be a combination of just we talk more, but we also generally don't have our problems addressed as much. Women generally tend to get more PR, and the only reason I've been able to figure this one out is that I noticed, I believe I read a number that 67% of producers were women. I thought that was kind of cool, so maybe there's an advantage for us there. So I find that usually women are a little better on the communication side, coming out of the gate with bootstrapping. They get farther because of this viral effect, because of the PR. That's just a thing, It's from the millions of entrepreneurs at this point I've mentored, that's what I've seen. But, it's hard for everybody. And I'd say B2B, a little easier than B2C, but that's because you're dealing with many less people to sell.
All right, thanks. Next. Well, I like that. Stand it up, bring the mic to him.
Thank you. My question is regarding compliance and with the Reg A, what's the secret? I get the things you need, like a slide deck, and you need projections, 3 years. What's the sequence of getting even the pre-Reg A and being able to have those conversations with potential investors?
I will not be able to answer that well. So Troy looks at me, I'm like, Troy, here's the mic.
Are you talking about pitching to non-accredited investors? So if
prior to having a Reg A, what's the compliance with
Reg A?
Series A.
Series A. Oh, so there isn't. So you said compliance in Reg A threw me off. So there isn't any compliance, right? If it's pre-Series A and I'm an angel, you could just tell me your story and I can write you a check. There are accepted things that people want to see, and I think Genevieve did a nice job of laying those out. But there is no requirement. There's no government oversight. There's no. There's some. Well, only if you're doing non-accredited, right? So here's the deal. If you're pitching to what are called accredited investors, and that is you have to meet a certain threshold. I think it's what, 250,000 in income for the last 2 years, something like that, or 2 million in assets.
It's a mill, or
1 million in assets.
right.
Whatever.
Hundreds.
There's a formal definition the IRS has of accredited investor. As long as all of your investors are accredited investors, the IRS stays out of it, or the SEC stays out of it, and says, you know what? Those are people who've made enough money. They're smart enough. They can spend their money however they want. If you want to pitch to or raise money from non-accredited investors from the general population, you do have a bunch of regulations that you have to go through, and that's what this whole crowdfunding thing is related to the Jobs Act.
Thank you.
And I think it's really important because if you go there first, it becomes complicated for accredited investors. And so
You go to non-accredited first. It
yeah,
becomes complicated for the
that's
accredited.
why I took pause in that, because we have to counsel our legal team around those issues, so it becomes complicated.
Thank you.
I have a
gentlemen. Let me toss this over to Sean, since, by the way, thanks for having us last Friday morning. Chicago booth, we came by and visited your office. Thanks for having us. So my question to you, I guess all of you, is about metrics. At what point do you think ARPU actually comes in? Because your first couple accounts may be reference accounts. You kind of a sweet deal and you get in this beta. Again, what point do you think ARPU, you start looking at it very diligently?
Years. I mean, years. I mean, you won't establish that in steady state until Series A. Everyone knows that. That's why I say sophisticated BS. Yeah. Also, it's going to completely change. Like Sitter City, for example, we started a subscription, but we're in the middle of redisrupting our own industry because we now know, we have this new product, Uber for caregiving. Do you have any parents here? Oh, cool. Little pitch for you. You're going to love me. Go to sittercity.com/date night and use code GenevieveVIP for a free 4-hour sitter, and they're all amazing. We actually do more screening on them than the nanny agencies do, so sittercity.com/date night is a great place. But where's I going with this? Oh, our metrics have changed. I just wanted to pitch you.
You're gonna start singing in a second.
I'm done now. Mic drop. Fears out. No, what I would say is our ARPU, we have no idea what it is for the new product. We know what it is for the old product, but be prepared in this crazy time, to even redisrupt your own disruption. So our ARPU, we have no idea what it is again. That's what I'm saying. So, you can have a company and know what your old ARPU is, not your new ARPU. So yeah. It makes, I mean, honestly, I would just measure, but also, like, try to talk to somebody who's done something comparable. Take a guess and work off of that guess until you know.
So, since that question was directed to Sean, Genevieve answered, whoever asks the next question has to go to Sean.
About women's issues.
Sorry.
Yeah.
It'll be fine.
Right here, we'll repeat it, or you can grab my mic.
Sorry guys, I interrupted your system. So there's a lot of great advice about when you have a meeting, what do you bring, what do you say? And I feel like you guys have a lot of great connections. If you wanted to shove 40 investors into that bullhorn and have those meetings, you're going to get those meetings. And maybe you guys have great connections as well too, but for those of us that don't have those connections, what happens a step before? What are you looking for to even allow someone to come talk to you? I assume you guys probably get asked a lot, can we have a meeting, can we talk, can we have a phone call? I assume you don't take all of them. I don't know, you might. But what are the things that you're looking for to even just like get that first meeting scheduled for those of us that don't have 40 investors in our back pocket in our Rolodex?
My answer to that would be, I'm sorry.
Oh, somebody buy Sean a drink.
Do that.
I'll buy you a drink.
Yeah, I would just say, start networking. You have to start talking to people, get interested. I mean, every single investor meeting I've ever had is from a friend. I would ask, anybody that you know in the community, ask Troy, he knows everybody. I mean, every meeting I've ever had has been through an intro. You're not going to get a blind email or phone call or VC that's going to be. So you have to start figuring out who on LinkedIn is a good way to do it. You can usually find, within a couple of degrees of separation, connection into that person.
I was going to say, like, if you just focus on the product, I mean, I don't think you're going to get blind emails off your contact form, but, if you start getting noticed, pretty quickly you get introduced to us.
So there are a couple of things. So LinkedIn is awesome. If an entrepreneur wants to meet with me, they should be able to figure out how to get to me through someone who they know who knows me 1 degree of separation. If you can't do that, you're probably not scrappy enough, number one. Number two, you're sitting here at 1871. If you go and look at the big chalkboard out there, investing, there's a whole section. You can have meetings with literally 20 investors this week, and next week, another 20 investors. So that's a good way to do those introductory meetings. And then
You actually have to be a member. I'm sorry, it's a good part to take.
That's what I said. Yeah, if you're a member at 1871, so for members. And then some people, so I do open office hours. So I do open office hours just about every week. So if you follow me on Twitter, you'll see it. I post them, and people come in, and I do 30-minute sessions, and a lot of people do those, and that's a way to get an intro.
And so that's a way to get the intro, but you want to make that time count. So think about what you're going to say. You want to be able to explain the problem you're solving and the metrics that you have, whatever it may be, in order for that person to understand that it's worth another meeting. So keep that in mind as well. So we are going to ask no more questions. I'm sorry. I wanted to stop. I thank you for everyone for coming out tonight. One of the things that I really encourage you is this is an ongoing series. We'll provide access, whether it's in this room or it may get sold out. It'll be online live. We'll do recaps as well as an ongoing vlogs to really fine-tune some of the questions, the answers to the questions that were asked tonight. I wanted a round of applause for the panelists. Really appreciates everyone's time. And for your entrepreneurs, I'll tell you something. You got to follow your heart, lead with your mind, and feed the hunger. Let's make Chicago great. Have a great night.